Welcome to Yahoo Finance Live. I'm Shauna Smith. Let's get you caught up with everything that has happened today, all of the market action. Taking a look at the major averages, you're now looking at the S&P and Nasdaq in the red. The Nasdaq, the laggard of today, off just about 0.2%. The Dow, though, holding on to gains, up just about 130 points. We had big bank earnings before the bell this morning. Also, the latest reading on the consumer driving today's action, consumer sentiment, the highest level that we've seen in about 2 years. And that's putting pressure on the broader markets and also driving the direction of yields. And taking a look at the 10-year, we're looking at yields pushing to the upside today. And of course, that print here fueling some of the speculation that the Fed is going to keep its policy tighter for longer. All right, let's first start off with the big bank earnings. JPMorgan, Wells Fargo, and Citi all beating the street's expectations. JPMorgan coming out strong in the second quarter, thanks in part to higher interest rates. Profit at the bank jumping 67%, lifted in part by the company's acquisition of the failed First Republic Bank. That was back in May. Now, Wells Fargo's profit surged 57%. The bank also raising its annual forecast for net interest income, and Citi beating the street's expectations, but revenue did fall 1% from a year ago, and net income did drop about 36%. So let's break it all down. We want to bring in Chris Whalen, chairman at Whalen Global Advisors. Chris, it's good to see you. So certainly just taking a look at these results from the big banks, specifically Wells Fargo and JPMorgan, very strong numbers here from those two banks. And it's almost like we're just forgetting about some of the crisis, some of the strains that we did see within the banking system earlier this year. What's your takeaway from these results and what it signals for the second half?
I think there's two big takeaways. First, the growth in the cost of deposits slowed down. So that's a big positive for the banks. We were worried that we could see deposit rates double this quarter, simply because of the aftershock from the three bank failures in the first quarter. So what you've seen is that slowed down, and also credit is basically flat. Most of the banks didn't have to increase their provisions for future losses because, frankly, the consumer is still okay. You're not seeing a huge spike, although you are seeing things like multifamily and commercial, obviously above average, if you will. But everybody else is still muted because of the Fed and quantitative easing. It's actually pushed down credit. And I think that's going to be a positive for the banks for the rest of the year. So what it comes down to is, can they continue to adjust? Can they find higher yielding assets on the one hand and somehow get rid of some of the legacy stuff from 2021 that they still own?
Chris, who is best positioned? Is it JPMorgan that's best positioned to make those types of changes, adjust their business in order to position themselves for growth here in the coming quarters?
Well, we put out a note a couple of weeks ago just looking at the first quarter, and JPMorgan came out of that very strong. They have a 10-point advantage in terms of their operating leverage versus the other three of the top four banks. That's extraordinary. They're down around peer group 1 levels, which is basically small banks, around 50% efficiency. And I really tip my hat to Jamie Dimon for growing the balance sheet on the one hand, but keeping his operating leverage down around the same as small banks. It's quite something. I mean, look at Bank of America, look at Wells. They're giving up 10 points of operating leverage to Jamie Dimon. So second quarter, he hit it out of the park, as you said. And I think you can expect to see them continue to do that because JB is better at managing the business, both in terms of the operations and also versus the Fed, and managing the duration of his balance sheet in a way that's at least not going to hurt him. The other banks haven't been that good at that. And I think you're going to see them tune that up. And I think the regulators, as you know, very focused on this, they're going to force them to tune up their market risk management.
Chris, how are you looking at the coming regulation within the space, the focus that we have seen on the banks? Obviously, when you take a look at the bigger banks, they are better equipped to handle some of the capital allocations, capital rules that are changing here going ahead. But what is that going to do to some of the smaller banks or mid-sized banks within this sector? Are we going to see further consolidation, and how much?
I think it's going to force some consolidation because some banks are going to be better at readjusting their balance sheet than others. And the ones that don't move quickly are going to get sold. Very simple. I think you're going to see the big bank group, what we call peer group one. It's 140 banks now. They're above 10 billion in assets, everybody from Jamie Dimon on down. That's where you see growth in the industry. So I think those 20, 30, 40 billion dollar banks are going to grow in number, as they should. And the big guys, frankly, would like to get smaller if they could. If you sat down with Jamie and his CFO, he would tell you he'd love to be closer to 2 trillion because he'd make more money. But, for now, they're doing fine. I think Wells Fargo is the most improved student in the class. I'm a little disappointed with U.S. Bank because they traditionally have been right next to JP in terms of operating performance. Citi, not a bad quarter, and they didn't have to increase credit provisions, which I think, again, was a big takeaway so far.
Chris, one sign of trouble, maybe we can say that, within Wells Fargo's report was the amount that they put aside for future loan losses. And I know you briefly touched on this before, but they did report $1.7 billion provision for loan losses, a lot of that attributed to some of the losses that we could see on office loans. Just give us a sense of what this tells us just about the current state and the risk that is still ahead, that is looming here for some of these banks when it comes to the losses in commercial real estate.
Commercial is chop salad. Every building is different. Every story is different. So you're going to see losses coming out of the Wells commercial book, and they're going to be quite idiosyncratic. They're going to be different sizes, and then you're going to see big recoveries too. So that's going to go on for years. This is a multi-year story. A lot of these commercial assets will be restructured or extended, and they'll try and buy some time and see if the market doesn't turn back in a direction. Because, does Wells Fargo want to take over a big multifamily building? No. They want that building to be functional and healthy and be able to support the tenants. So, that to me is going to be the story for most banks going forward in the next year. It's not going to be residential. This is not like 2008. This is a different kind of credit story with multifamily as well as commercial office space. Kind of on the block. You can see it in the specialty press if you follow The Real Deal and some of the other media that really focus on the commercial market. It's all over the place. You got buildings going into bankruptcy, being auctioned. You got other buildings that are financing in good order. You got cities like San Francisco. No bank wants exposure in San Francisco right now. And I think the bank regulators have told the banks to be very careful of legacy, B and C class urban office space. That's been the message for a while. So I think, every bank I look at, credit efficiency and how well they recover from default is always one of the first things I assess. And I think, the small banks have commercial exposures in the community. And then as you get up into the bigger banks, they're national. They have exposure to all kinds of deals everywhere. You can see fatigue in places like Texas and some of the other hot markets. They're definitely overbuilt now. Houston, even, believe it or not, Austin, Texas, which has received enormous amounts of inflows of investment over the last few years. So,
yeah, certainly a story that really varies.
New York City.
Yeah, regionally.
There's a lot of mezzanine finance in New York City held by banks. So,
yeah,
we'll hear about that.
Yeah, and then there's also, of course, the pockets, like you were saying, just that are strong and that are on solid footing within commercial real estate outside of office. Chris, let's look ahead to next week because we're also going to be getting a report here from Goldman Sachs. And we know Goldman obviously more exposed or more reliant, I should say, on trading and deal activity. Are we going to see a different type of report from Goldman?
Oh, yeah, you always do. They're much more focused on the investment banking side. I think the guidance has been that that side of the house is going to be light. You're going to see credit expenses continue to work themselves out as they shut down Marcus and get out of that business, really. And then the question is cost of funds for the whole enterprise. It's going to be high. They and Morgan Stanley, frankly, have both seen the market side of their business reprice very quickly. So they're paying market rates today. They both have banks. Morgan Stanley's got a bigger bank than Goldman. And the bank doesn't really support either firm entirely. It's not like Schwab, where the bank is kind of a nice thing to have, but they don't need it. So I think that the way I would put it is I'm looking to see how well the capital markets business is being managed and see if they can avoid other credit stumbles, I guess is the way I would put it. Morgan Stanley's in a different space right now than Goldman. They have bigger AUM. I think a more stable business, frankly.
All right, well, we will see what the results next week tell us about the health of those two banks.
Yes.
Chris Whalen, always great to speak with you of Whalen Global
My pleasure.
Advisors.
Have a great weekend, guys.
Thank you, too. All right, well, there are plenty of market movers outside of financials today. Jared Blickery joins us here from the big board, showing us some of those moves. Jared, what are you looking at?
I'm seeing some of the markets here, some of the majors turning red, and I'll just show you a couple charts. Here's the Nasdaq. Started off the day in the green and has just drifted off to the lower right side. And you can see just barely off of those lows, but nothing big, 0.3%, nothing to write home about. Dow, on the other hand, has been positive all day. And the Russell 2000, which started out the day negative, has gotten more negative, although still off of its lows. Those lows came in just before 11 a.m. For the week, though, everything in the green, and not just green, but solidly in the green. Want to make that distinction here. Here's the sector action for today, healthcare in the lead, but I want to show you what's been happening these last 5 days, because really interesting. I was writing about this for the Yahoo Finance blog, and the mega cap sectors are really flying this week. We have communication services that houses Alphabet, as well as Meta. Consumer discretionary, that's Amazon, along with a bunch of retail names. Utilities is defensive. Then we have tech, which of course we know that is Apple, Nvidia, and the rest of them. That has been soaring, and that is on the back of dropping yields and also a dollar. Here's the 10-year T-note yield over the last 3 months. And here's where we were last week. We punched above very quickly. We got up to just above 4%, and now we have rejected that level. I want to show you a longer term chart so you can appreciate what's happening here. Is this a double top? Too hard to say just yet. In fact, what it's actually looking like to me is a bull flag, but also too early to tell that. So I'm not going to draw any big conclusions there. But I do want to show you the US dollar index, now just up a little bit. Here's a year-to-date look, because I want to show you how it has really fallen off a cliff here. This has been a tailwind for a bunch of different asset classes, not just stocks in the US, but also emerging market stocks, commodities, even crypto. And let me get back to the crypto market here, just kind of shift gears, because this is something that's moving right now. I was noticing Bitcoin just punched above 30,000 only yesterday. This is today's since midnight, the price action UTC. We can see it's plummeting right now. Is it not a huge move in the context of what it's been doing recently, but is noteworthy because anything above 30,000, huge overhead price resistance there. So is Bitcoin leading the way down? I don't know about that, but just take that with a grain of salt here on this summer Friday.
And we will. Still above 30,000. Pretty remarkable given all the headwinds that we have seen with crypto. All right, Jared, thanks. Well, we are just getting started here on Yahoo Finance Live. Coming up, the Fed's monetary policy playbook. Many officials signaling their support to raise rates later this month. But what comes later this year? Well, that remains up in the air. We're going to talk to Gina Smilik, New York Times Fed reporter. She'll give us her take on that upcoming decision. And Hollywood goes dark as actors join writers on the picket line for the first time in over 60 years. We're going to break it all down and what this walkout means for the future of streaming and the box office. We'll be right back. Let's do a check of the market sponsored by Tasty Trade. You're looking at a mixed picture here, at least for today, with the Dow holding on to gains up just about 0.5%. The S&P essentially flat. The Nasdaq in the red, off about 0.2%. Flipping over to the VIX, which we want to get a quick look at here. The fear gauge index, that of course falling even further, up another 2% today, 1334. Well, second quarter earnings season is underway, and big names like JPMorgan, PepsiCo, and Delta all beating the street's expectations. But is that enough for investors and for the market to continue here to the upside? We want to discuss with Ross Mayfield, Baird Investment Strategy Analyst, and George C., Annandale Capital Founder and Chairman. Great to see you both. Ross, let me start with you. When it comes to even the results that we saw today, JPMorgan, Wells Fargo, Citi, the trading action on those stocks have been mixed despite the fact that all three beat the street's expectations. So beating the street's expectations, is that not going to be enough once again this quarter?
I think it's going to be enough to keep stocks from really retreating from this rally, but I don't know if it's enough to spark the next leg higher. We saw, as we did in Q1 and as we see in most quarters, expectations and estimates drop across the quarter until the earnings season is really de-risked. But when you beat those estimates, you're beating kind of a lower estimate than otherwise would be expected. So I think unless you're seeing big beats, double line beats, maybe it's not enough to spark the next leg higher for a market that's, sitting at bull market highs or the highs for this cycle. So I think it'll take a little bit more than just beating these de-risked estimates to spark a new leg higher.
George, is it more about guidance? We certainly know that is something that investors take very seriously, what they are focusing on when you're trying to gauge what the results are going to look like 2-3 quarters out from now. Is that going to be really the driving factor here?
Well, that's the right question, Shauna. You have classic sell the news today, and you're going to have to really outperform what the street is looking for to continue upward momentum in stocks. And you see that the Fab 7 stocks that have led the markets higher so much this year starting to stall out a little bit. And the market just looks heavy and looks tired. And we've had such an unbelievable rally the first half of this year. I don't think it'll be too difficult to have some factors come in that make it a lot harder for the market to press higher, especially the Nasdaq that is up so much more than the rest of the market this year. It just looks toppy and tired and ready to take a break. And the VIX is showing a lot of complacency. I think that going into the fall, we may get a little more volatility coming in.
Do you agree with that, Ross?
Yeah, I mean, look, Q2 was as calm a quarter as we've had in 3 or 4 years, really in the post-pandemic era. If you look at the VIX making a 3-year low, if you look at something like the lack of plus or minus 2% moves for a day, it was a really calm quarter despite some of the headline news and noise. So I do expect volatility to pick up, especially, July is usually fine, but getting into August and September are typically seasonally challenging months. You do have extended valuations. You do have rates spiking a little bit over the last couple of weeks. And so do we expect some volatility? Yes. But at the same time, we respect the momentum and the resilience of the market from the first half. And if you look at history, a first half strength like we saw has really been a bullish signpost for the second half. We might just have to get towards the end of the year, towards Q4, before we really start to reap those results.
And George, we're also starting to get some commentary on the consumer. We heard it from a number of the bank CEOs this morning. Citi CEO Jane Fraser saying that we are seeing a more cautious consumer, but not necessarily a recessionary one. What are you expecting to hear this quarter about the health of the consumer?
I think every aspect of the economy is going to start fading somewhat, Shauna. I do think the Fed has engineered a pretty brilliant soft landing, which I always thought was kind of the most likely outcome because we had so much stimulus in the market. They did have to jack rates up that excessively to bring inflation back to bear and bring the economy back to a more gradual, steady state growth rate. But I think that, again, back to exhaustion, I think that these interest rate increases, they don't immediately handicap the economy and the market and the consumer. It's about a 9 to 18 month lag period in between the time they start jacking up those rates to see the really significant impacts of it. And I think this fall, this winter, and maybe even into the spring, we're going to start to see some real overhang from that and some real pressure on the consumer and the markets and the overall economy.
Ross, let's talk about some of the data that we got out this week because we got a few readings on inflation. Also, the U.S. consumer sentiment rising for the second straight month, the highest level that we've seen in almost 2 years. And this sharp incline largely attributed to the fact that we are seeing inflation ease just a bit, stability in the labor markets. But Ross, how do you think the Fed is looking at the data that we've gotten out over the last several days and what that tells them just about their fight against inflation and how much higher they need to go with rates?
To me, it would say we could look at a pause or maybe one last rate hike. But what the Fed is saying is they still want to do 2 more hikes, if not more down the road, if they view inflation as not properly anchored. And they might look at the CPI data, the PPI data, and be encouraged. They might also look at core CPI still around 5%. Or in the consumer confidence report this morning, inflation expectations still kind of anchored above 3% and see reason to keep hiking. If I were, the Fed, I would definitely be pausing here. I think the disinflationary trend is obvious. I think you can engineer a soft landing if you don't go too far here. But what the Fed wants to do has been made clear. They want to do 2 more hikes this year, and they want to keep the optionality to go higher if inflation isn't where they want it at 2%. They want to be higher for longer, and I think they feel like they can do that.
George, if we do see another rate hike, is pretty much a sure thing, although you never say that. But largely in terms of what the traders are betting on, they think that it's a sure thing later this month. If we do see, though, 2 more rate hikes before the end of the year, what does that mean for the labor market and what that's going to look like by year end?
Well, as we've seen so far, it hasn't meant much. The labor market is still incredibly strong, and we've seen a lot more rate hikes than just another 25 to 50 basis points. I think the Fed's got 1 to 3 hikes left in it, but I don't really like this slow and steady gradual drip methodology they've been using. I was calling 6 months ago for them to do a 75 basis point hike early this year and say, we're done. And we may be done for good, but we're done for at least 6 to 8 months, give the market some certainty. And this slow drip may not matter for now, but eventually it may matter for the market. If short-term interest rates get up around 6%, all of a sudden people look at the multiples they're paying for NVIDIA and Microsoft and some of the other more speculative stocks and go, whoa, with 6% short-term rates, we've got to discount these earnings more. So I wish they'd get it over with and hit a pause and then assess how the economy reacts. And I agree. I think that's going to happen pretty soon. I hope it's sooner rather than later.
Ross, let's talk about how to play all of this here. Bank of America strategists, they were out with a suggestion today saying to short stocks as global equity funds see inflows of nearly $70 billion in the past 7 weeks. And I think this massive run up that we've seen since the start of the year, a lot of strategists are saying, hey, maybe now is the time for a pause. Do you think it's time, Ross, for some caution from investors?
So I think sure, a sign for some caution, maybe expectations of volatility and some sideways trading for a bit, but I don't think it's time to get bearish or short stocks. As I mentioned, if your first half is 10% or greater, your second half has a higher percent chance of being strong. So the momentum in the market is really something to be respected. Maybe a rotation into some of the more cyclical value stocks. Economic momentum is pretty strong. Economic surprise indices are at multi-year highs. You're starting to see just a little bit of percolation from something like energy. Industrials have been the story of the market, if not for tech. So I think there's still opportunity out there within the equity market to maybe rotate into something that looks a little bit more, a little bit cheaper on a valuation basis, but without, trimming your exposure to stocks, which are really responding to a stronger economy and have been resilient in the face of a lot of headwinds this year. So we're not getting bearish yet.
George, where do you see the most opportunity today?
Well, I agree that trying to time the market, I think, is a fool's game. And I don't advocate, we at Annandale Capital don't advocate that for anybody. But I think you ought to look hard at your allocation and make sure that whether it's 40% or 60% or 70%, you got the right allocation to stocks. And if you've had a big move in your technology and other kind of high-tech related growth areas of the market, you ought to look at trimming those or potentially writing some call options against them and look at sectors of the market that are much more attractive because they've been left behind this year. And as mentioned previously, that's energy. I would say that's also healthcare, and I would say financials too. We think regional banks are very attractive because they got thrown out so hard earlier this year, and there's going to be some consolidation in that space for sure because they just can't compete with the big money center banks. And I think exposure to the best of class money center banks like JPMorgan is a great idea too. There was a sell the news today movement going on among the street, but if you own the best of class firms in that area too, that's a good idea. So I would look at it less as trying to time the market or make a draconian reduction in your stock exposure, more to rotate to areas of the market where future upside is more attractive than it is in some of the stuff that's rallied so hard this year.
All right, George C. and Ross Mayfield, great to get your perspectives here on the market. Thanks so much for joining. Have a good weekend.
Thank you, Shauna.
Thank you.
All right, well, coming up, inflation is trending in President Biden's favor, but we still got a long ways to go in order to get voters on board. We break down what the latest CPI reading means for the president's re-election campaign next. Americans are finally catching a break on inflation. Data out this week showing consumer prices in June rose at the slowest annual rate in more than 2 years. And wholesale prices rose less than expected. This is good news for the Biden administration, especially as President Biden struggles with low approval ratings as he kicks off his re-election campaign. Here to break it all down, Yahoo Finance's Rick Newman. And Rick, in this week's Bidenomics, you're taking into account that yes, this is a step forward here for the president, but are voters going to notice?
So a couple of interesting data points here. Good news on inflation, as you mentioned. And also today we saw a notable improvement in consumer confidence, biggest jump in almost 2 years. And a lower inflation has a lot to do with it. However, that is just not showing up at all in President Biden's approval rating. So inflation has dropped from a high of about 9% last June. It's now down to 3%. 3% headline inflation. If it were just at 3%, just sort of hovering around there, nobody would really care that much. But of course, the problem here is that all the price hikes that have been built into the system during the last 2 years. And here's the real problem for President Biden. Inflation since he came into office is up 16%. That's from January of 2021. And incomes are only up 12%. So even though inflation is coming down, people have fallen behind relative to inflation. That means the typical family's purchasing power has dropped. The typical paycheck simply buys less. So what will make people feel better is if we actually get falling prices or incomes rise faster than inflation for many months in a row, and that does not further add to inflation. So people feel like they're finally getting ahead of price increases for once. For now, they don't, and it's not a mystery why Biden remains unpopular. That's the reason right there. People need to feel like their paycheck goes further.
Well, Rick, something that might help win some voters back in his favor is the fact that he automatically did forgive the Biden administration for giving $39 billion in student debt for just over 800,000 borrowers. It's a result, though, and this is important to point out, of something that the Biden administration needed to do here, administration's fix here to repayment plans. It's a victory for borrowers. How do you think that's going to translate? Is it going to really move the needle when it comes to the polls?
That alone is not going to move the needle. So just to put it in context, Shauna, the big program, the big executive action that the Supreme Court shot down would have forgiven up to $20,000 of student debt for more than 40 million Americans. This affects only about 800,000. There seems to be a good chance this will stand. It's just a tiny fraction of all the people who have student debt. But what Biden is clearly going to do is he's going to campaign for re-election on this issue of student debt. He's already saying it, and I think he's going to continue to bang this drum. He's going to say, I've done everything I can on my own to help people out who have overwhelming amounts of student debt. But the Republican-led Supreme Court overturned it. And in order to really get this done, we have to elect more Democrats to Congress. He is definitely going to run on that. Whether that's going to make a difference, who knows? Is it going to, push up turnout among younger voters and, the people most affected by this? It could. And there are going to be other important ways he's going to be trying to do that as well. But Biden's just going to try to turn this into a campaign event where he says, I'm doing everything I can. But in order to really help, we got to elect more Democrats.
All right, well, we will wait and see what this message is from the Biden administration over the coming year and a half. Rick, I love the little shimmy as we entered the segment. I caught the very end of it.
That music makes me want to dance. That weekly Bidenomics music. I mean, plus it is Friday.
I was going to say Friday afternoon. It's the perfect time to dance. Yeah. All right, Rick, we're going to leave it there. Thanks so much. Have a good weekend.
See you, Shauna.
Well, it has been a busy week for the Federal Reserve, and there wasn't even a policy decision. That's still 2 weeks away, but we've heard from several Fed presidents offering their perspectives on the future path of rate hikes as inflation cooled in June. And on top of that, James Bullard announcing Thursday that he's stepping down as the president of the St. Louis Fed after 15 years. Joining me now is Gina Smilek, New York Times Federal Reserve and economy reporter, also author of Limitless, the Federal Reserve takes on a new age of crisis. Gina, it's good to see you again. So certainly a busy week here for the Fed in terms of some of the comments that we got out from Fed officials, but also the slew of data and how they are looking at their fight against inflation, maybe how successful they have been. How do you think the Fed is looking at the reports, the CPI and the producer prices report from this week?
Yeah, I think that the Fed has got to be sighing just a huge heaving sigh of relief at this point, because it was a really good inflation report, this last one, and it was good for all of the right reasons. We saw a slowdown really across the board. Services prices are finally slowing down a little bit. We're seeing a slowdown that extends to everything from airfares to used cars to new cars to rent. And the fact that it's got so much breadth, the fact that we're seeing a slowdown in inflation that sort of spans a lot of different price categories is great news from the Fed's perspective, because it means that this might be sustainable. That's a big difference from the last time we saw a slowdown. Like, we've had some false dawns before. We've had times when inflation really looked like it was moving down and then popped right back up. But I think the thing that distincts this moment is that we're seeing a really broad-based slowdown. And so I imagine the Fed is feeling a lot better after this week.
Gina, what about the timing of the coming meetings here? So we have a meeting later this week with the Fed decision. Obviously, traders largely expecting the Fed to hike another 25 basis points. But then we have Jackson Hole. So the next decision after that isn't until September. The fact that the Fed is able to buy more time to look at the economic data, is that a huge advantage?
I think this is actually great news for them, because we know they're going to move this meeting. They've made it very clear that that's the intention. Nobody has walked it back, even after the inflation report. So it seems very likely that they're going to raise rates another quarter point, which almost immediately makes the debate, what happens at that September meeting. But we just have such a long time. We have 2 inflation reports. We have several jobs reports. We just have so much data coming in between now and then that we have plenty of time to sort of suss out whether the cooling down that we're seeing right now is legitimate, whether this is the real deal, before they actually have to make another choice. And I think you can see how important that is by the fact that even Chris Waller, who's probably one of the most hawkish members of the Fed's voting committee, made a speech last night where he said, we are going to hike rates. We might hike them twice more, but that second hike, it's going to hinge on whether we see inflation picking back up. If inflation continues to look like it has in the last 2 reports, we might not do that in September. So, I think we've got a very data-dependent Fed for the next couple of months.
Well, Gina, we also had the news this week of St. Louis Fed President Jim Bullard stepping down, resigning. And we know that he has been one of the most vocal hawks, at least as of late, to raise rates, saying that it's very important to get ahead of the fight here against inflation. Do you see any significant near-term implications of this move?
Yeah, I think one interesting thing about him leaving is he does tend to be sort of a bellwether for the hawkish side of the Federal Open Market Committee. So he's not a voter currently. He was going to term out fairly soon anyway. Fed officials have to retire from their reserve bank jobs eventually, and he would have within a few years. But I think that what's really meaningful here is we're not going to have that super hawkish voice that he has been bringing to the table. He worked very closely with Chris Waller, who's a board governor at the moment, but who previously worked with Bullard at the St. Louis Fed. And so we may still get some of that flavor in the conversation from Chris Waller. But I think Bullard was always a little bit, louder and more forthright with his views than I think just about any other Fed official. And so him leaving will take that element out of the conversation.
And Gina, with him leading, there has been some reports, or I should say maybe more of the focus just about what is exactly going to be discussed at the meeting later this month. And maybe not so much about future rate hikes, but what it's going to take for the Fed to cut down the line. How do you think the Fed is looking at that decision, and how much of that conversation do you think will be focused on that angle?
I would be surprised if very much of the conversation at all was focused on that angle. I don't think that they think that they are at a point where we are even having a conversation about cutting interest rates. Inflation may be at 3%, but 3% is not 2%. And that's the headline number, which incorporates a big decline in gas prices that you wouldn't necessarily expect to be continued. And so I think they're probably looking at that core inflation number. That's still at 4.8%. That's quite a bit above the 2% run rate that they feel comfortable with. And so, we're still not at target. We're headed in the right direction, but I don't think they're going to be so ready to declare victory that they're already having a conversation about when to cut interest rates.
Yeah, it might be quite some time before we hear that. All right, Gina Smialek, always great to have you. Thanks so much of the New York Times.
Thank you.
Well, coming up, the future of Disney. Disney extending CEO Bob Iger's contract by another 2 years. And while most of Wall Street remains bullish on the stock, our next guest is signaling some caution around the House of Mouse. We've got all that for you next. The World Health Organization warning about possible cancer risks from aspartame, an artificial sweetener found in diet sodas. But there is more to the news. Joining us now, Yahoo Finance senior reporter Anjali Khemlani. Hi, Anj.
Hey, Shauna, that's right. So new news out from the World Health Organization, warning about aspartame in certain common foods, diet sodas just being one of them. You may be familiar with some of these others, and you're going to hate this list. It includes chewing gum, gelatin, ice cream, dairy products like yogurt, cereal, toothpaste, and cough drops and chewable tablets, as well as some juices. So a lot of stuff that we regularly consume. So of course, the cause for concern when the World Health Organization comes out with this warning, but there's a lot of caveats to that. And that includes that there is limited evidence at this time about what the risk is. And basically the totality of the statement says there needs to be more studies done by the joint committees that created this report and came out with this result. So just a recap of what we've seen over the years. I don't know about you, Shauna, but I definitely remember this being a topic of concern, like 20 years ago. So it seems like not a lot has changed. And that was kind of the result of the report, which is you can continue consuming within the daily limits that the global health forces as well as the FDA have, which is the equivalent of about 9 to 14 cans of diet soda for a person who weighs about 154 pounds. I certainly don't drink 9 cans of soda a day. I don't know about you, but it seems like status quo is the bottom line for right now.
I love Diet Coke, but I'm nowhere near that 9 cans a day. So at least for now, in the research that they have, it looks like we are okay and in the clear. So it sounds like it's all about moderation. All right, Anjali Khemlani, thanks so much. We are closing out a big week for the market and the economy. We've seen data showing inflation is cooling. We kicked off second quarter earnings with some upbeat results from PepsiCo, Delta, and some of the big banks. But there's still a lot of uncertainty about whether the U.S. is going to fall into a recession and the impact that could have on companies' future earnings. Well, here to help us navigate some of this uncertainty, some of his picks, and also some stocks to stay away from, we want to bring in Ben Kirby, Thornburg Investment Management co-head of investments. Ben, it's good to see you here. So let's start with one of your picks, and it goes along the theme with bank earnings today, but you're looking at a name, Charles Schwab, one of the banks that was caught up in the regional crisis that we saw play out earlier this year. Why are you seeing a buying opportunity?
Yeah, well, thanks. Great for having me on the show. So look, I think the economy is slowing. So let's try to find some investments that can be resilient even as the economy slows. And we think Schwab is one of those. So Schwab is a very high quality, large cap, blue chip company. It's compounded earnings at 15% a year for the last decade, but the stock is down 30% this year while the market is up 17%. So Schwab used to trade at a 20% premium to the market. Today is a 20% discount to the market. We think that valuation will close over time. Schwab is not facing liquidity challenges. They're not facing solvency challenges. They have a near-term earnings headwind from higher rates. They're going to work through that, and we think the premium will come back over time.
But what about the crisis of confidence, though? Because we know so much of what happened and what played out with the regional banks and even the larger names was because consumers didn't know what to think. They didn't know how confident they should be in their banks. Is there still some lingering risk from that line of thinking?
There's still lingering concern, and I think that's the opportunity. Schwab is in a totally different bucket than some of the banks that were really challenged. Schwab has continued to get net new money inflows over this time period. We think that the bank is really not in any stress. They have liquidity. They're going to work their way through this, come out the other side, a stronger company, we think still with a very attractive growth profile.
And their executives, of course, have been extremely vocal just about their positioning amid all of that fear. All right, Ben, let's move on to your next pick, and that is BioMarin Pharmaceutical, one of the mid-cap biotech companies. What's the bull case here?
It's another name that's been left behind in the year where, again, S&P up 17, this name is down 17%. They just got approved for a really important drug called Roctavian, which is for hemophilia A, and it's going to significantly improve patients' quality of life. Instead of having to go to a treatment center on a regular basis, you can take Roctavian and you won't have to go there for 4 years. So it's going to significantly improve patients' quality of life. We think that peak sales for this drug are probably $1.1 billion or higher. and the stock's trading at about $85. We think that just on pure fundamentals alone, it's probably worth $120, maybe $130. And we think it's an attractive M&A target. And in an M&A scenario, it goes to $200. So we think maybe $10 of downside in the price and more than $100 in upside if things play out over the next 6 to 12 months.
All right, Ben, let's flip over to stocks that you're saying to avoid. And your first pick is a name that has certainly generated a number of headlines over the last couple of days, and that's Disney. We know CEO Bob Iger is going to stay on 2 years longer than initially he committed to. He also made some comments just about the strategy for Disney here going forward. Why aren't you too confident that he's going to right the ship quickly?
You know, Bob Iger is a great CEO, and the fact is Disney has great content. They have great brands. It's a great company. The problem is they have a lot of challenges facing them right now, and it's just going to take a while to turn it around. I mean, what's very clear again is the consumer is slowing, and Disney is exposed to that. We see parks visitation is down significantly in the current year. We've seen the reporting on that. So a cyclical component. They're also facing structural pressures from the decline of linear TV. That's impacting even ESPN as well as some of their other assets. And the direct-to-consumer business, the streaming business, is burning cash. And, you know, we think that they can maybe make break even in a year or two. But the fact is, it's not a great business. It's burning a lot of cash. So we just kind of put it all together, strengths aside. There's cyclical pressures. There are secular pressures. We think there's going to be better places to invest and kind of sidestep the slowing economy that Disney's going to get hit by.
Ben, speaking of the slowing economy, your next play that you're saying to avoid, or really a sector here at this point, or a group of stocks, I should say, is the buy now, pay later space. How much more weakness are you expecting to see from the consumer?
Especially the low-end consumer, I think, is most at risk. So high-end consumers, if you look at excess savings and sort of, you know, net wealth accumulation from home prices going up, from the stock market going up, from bond yields falling a little bit, all of those indicate that the high-end consumer is still in a pretty decent position. The low-end consumer, though, look, student loan payments are going to be coming back. Stimulus is gone, and they've worked through all their excess savings, and they've had a lot of tailwinds in the last few years that are going to be reversing. So a strong job market has led to rising wages. That's going to be reversing, and so we think that as we slow, you're going to see layoffs, you're going to see wage growth slow, and that should lead to, in a traditional cycle, and we think in this one as well, higher default rates among some of those lower income consumers. So it's a cycle, and we think that we're entering the slowdown phase. So stay away from those parts of the economy and those parts of the market that are going to be most exposed to it.
All right, Ben Kirby, great to get your picks. 2 names to buy, 2 names to avoid here as we look ahead to the remaining of the year. Ben, thanks so much.
Thank you.
Well, Hollywood actors joining writers on the picket line. SAG-AFTRA, the union representing over 160,000 professionals in the industry, has voted to go on strike after they failed to reach an agreement with major studios. We're going to discuss what all this means for the entertainment industry on the other side. The hype around the upcoming Barbie movie has given Mattel's stock a boost. Shares are up just about 15% in just the last month. And there's a lot at stake. Barbie is the first in a lineup of movies that the company has planned based around its toys.
Hi, Barbie.
Hi, Ken.
I thought I might stay over tonight.
Why?
Because we're girlfriend-boyfriend.
To do what?
I'm actually not sure.
Mattel is betting big on the Barbie movie. The live-action film, starring Margot Robbie as Barbie and Ryan Gosling as Ken, reportedly has a $100 million budget. It's a toy maker's big chance to shake up its brand and prove that Barbie is still relevant. Barbie sales accounted for $1.5 billion of Mattel's $5 billion plus worldwide sales last year. It's a big number, but it's still down 11% from the prior year. Mattel unveiled the first Barbie dolls in 1959, and the company went public just a year later. The 1960s was transformative for Barbie. The Ken doll was introduced in 1961. The first Barbie dream house popped up a year later. The doll's popularity took off, with sales passing $1 billion in the early 90s. But within a decade, the doll began to fall out of favor amid criticism for lacking diversity and promoting an unrealistic body image. As Barbie sales struggled, so did its IP owner, Mattel. The company lost its spot as the world's largest toy company by market cap to Hasbro in 2015. Attempting to address some of the criticism, Mattel released a more body-inclusive doll line in 2016. 2 years later, Ynon Kreiz was named Mattel's chief executive, and he brought a new vision to the brand. Dig into Mattel's vast IP and pull out the toys that could translate into hit movies. In addition to Barbie, Mattel is planning 14 more films based on toys.
It will be a way for us to show what does it mean when we say that Mattel is an IP-driven, high-performing toy company, and an opportunity to extend our business outside of everything we do on the toy side of the company.
Between Mattel's business and the lackluster return to the movies, there's a lot riding on the film. So will people show up? We did a little research of our own.
Of course, I have plans to see the Barbie movie. I'm so excited.
Yeah.
Oh, yes.
Yeah, absolutely. I want to see it.
Yeah, unofficial plans.
Yeah.
I'm definitely going to see it.
Yeah, definitely.
Yeah, I would love to see it.
I want to
see it. I've been waiting for this for years.
We've had an astronaut Barbie, CEO Barbie, and presidential candidate Barbie. But will we get a blockbuster Barbie? We will see whether this hype translates into a Barbie boom. Well, the Barbie movie, it hits theaters in just 1 week, and the film's actors have been on a marketing blitz the past month to promote it. But that campaign is over now after the Hollywood Actors Union, SAG-AFTRA, voted to go on strike. Yahoo Finance's Alexandra Canal is with me, who has been following this story very closely. And Ali, the question here is what this means for the box office. Could the box office potentially take a hit now that some of the movies, the big stars, are not out promoting it?
Well, Shauna, the one thing I'm going to say is thank goodness this SAG-AFTRA strike happened now and not before they started this press tour for the Barbie movie, because Margot Robbie's outfits were just so iconic. So I'm happy we at least got to see some of that. But absolutely it could. I mean, the timing here, it kind of stinks for a company like Mattel and Warner Brothers Discovery, considering how much is riding on the success of this movie. The fact that now all marketing, all press has to stop at this point when we're a week out, that's disappointing. And that's something that I think a lot of people don't really think about. It's not just the acting, it's everything that happens pre-production, post-production, the junkets, the red carpets, all of that that's in anticipation for the movie has to stop. And, you know, that video package is talking about the importance that this is for Mattel, the future of Barbie. But like I said, it's also very important for Warner Brothers Discovery, which has been lagging at the box office recently, especially when we talk about some of their DC movies like The Flash. That was a big disappointment. So they're really hoping that the Barbie movie can deliver this jolt, this box office boom. So far, it seems like it is, considering how much hype is around this, but you just never know how that will translate to ticket sales. Because remember, we talked about Disney's The Little Mermaid for so long, and that was a bit of a disappointment. So again, you just never know what the consumer, how they're going to react in this post-COVID environment, especially at the box office, but certainly a lot riding for this film.
Yeah, Ali, there is so much riding for this film, and I know you've talked to so many people within the industry over the last several weeks just about what this will signal for the return to the box office. If we don't see a huge hit here from Barbie, how worried should we be just about movie theaters here going forward?
Well, especially with not only the SAG-AFTRA strike, but also the ongoing writer strike. That's a double whammy that is going to impact the box office, especially as we head into the back half of 2023 into 2024. And Barbie has been branded as one of the most significant movies at the box office this summer. It will come with a slew of other big titles like Mission Impossible, Oppenheimer. So if this doesn't do well, it sort of signals, okay, well, what kind of movies do consumers want? What is the new genre that we need in order to get people back to the theater? And I think a lot of people will be questioning the future of the box office and how vital it can be during these uncertain times. So certainly everyone is going to have their eye on those ticket sales, and they're hoping that it can surpass those estimates.
Yes, certainly a lot of people will be tracking this very, very closely. Allie, what are you hearing just about the timeline, I guess, how long this strike could potentially go on and when we're going to start seeing a significant hit here now that actors and the writers are not working?
Well, I don't think we're going to see any immediate impact this year, but from what I've been hearing from analysts and industry experts, by 2024 is where we could see some of that impact. I do expect this to continue through the summer and possibly into the fall, but it sort of feels like this situation of who is going to cave first. Is it going to be the studios, or is it going to be the writers and the actors? And that's never a good position that you want anyone to be in. The stakes are very high.
Yeah, stakes are very high. All right, Allie Canal, great stuff. Thanks so much. We want to get over to the closing bell on Wall Street as we wrap up the market's action for the week. You're looking at a mixed picture here for the day. The Dow closing up just around 115 points off the highs of the day. The S&P just below the flatline, off about 0.1%. The Nasdaq coming back a bit here in the final minutes of trading, closing off just about 0.2%. This market check sponsored by Tasty Trade. All right, taking a look at some of the individual movers, it certainly was a big day for banks. JPMorgan, Citi, Wells Fargo kicking off earnings season with a beat in earnings here for the second quarter. However, there were some things to be a little bit concerned about within these reports, and digging into it, Citigroup saw profits fall amid slower corporate spending. Yahoo Finance's Jared Blicker here to weigh in. And as you can see, JPMorgan, one of the only big banks here, holding on to gains today. The fortress balance sheet, what can you say about that? That hasn't been said before. They tend to win, and the First Republic acquisition looks like it's working in their favor. You can see they're one of the few, if not the only one, up today, up 64 basis points. Wells Fargo, now they started out the day in the green. They were up 2 or 3 percentage points, have sunk into the red. Over the last few years, the really big year for banks was 2021, and they've just been kind of flagging ever since. Here's Citigroup intraday down 4%. But I just want to show you a chart, Shauna, to argue against zombie banks. Because guess what? This was before the global financial crisis, the great financial crisis, and this is after. Basically 12 years of doing nothing there. So that is the downside. Certainly the downside. All right, Jay, let's also talk about some of the chip makers. Truist was out with the note raising their price targets for NVIDIA and Broadcom. Now, the company is citing that the two chip makers having, quote, meaningful upsides right now amid AI demand. Certainly, obviously, NVIDIA by far what are we looking at losses today? Yeah, well, I mean, we're looking at some losses today, but that chart is from the lower left to the upper right here. So if they're still seeing meaningful upside here, hey, I want to be part of that. Let's not forget, a lot of this huge rally that we've seen here in this market concentration has been on the backs of some of this AI, not on some of it, a lot of it on the AI hype. So that does need to continue. But up 200% for the year, that is just incredible. Take a look at Broadcom here, who they're also commenting about, up about 60% year to date. The stock is just flagging in the upper end of its range. Well, that's a very bullish chart right there. We'll have to see what happens. But this consolidation that we're seeing here, that's healthy. All right, Jared, well, another name that's on the move today, United Health Group, rallying in today's trading session after beating second quarter expectations. The company also raising the low end of its profit outlook for 2023. Obviously, that's adding to some of the boost that we did see today, and it's helping some of its competitors as well. Yeah, we can see kind of a mixed board here. I would say overall, healthcare has not been one of the best performers this year. It has not been about defense. They did tend to do well last year, especially in the back half. And you just take a look at the year-to-date performance, you're going to see kind of a bifurcation. You're going to see some winners here, but for the most part, a lot of them are losers. We know healthcare is a very difficult business to be in. One of the items that caught my mind with respect to United was a bunch of the states are getting together and finally
clamping down on Medicaid and kicking out people who committed fraud or were not eligible over the pandemic does not seem to be having an appreciable effect just so far. But I think that's an interesting data point that could be important going forward.
All right, Jared Blicker, thanks so much for breaking that down. I want to get to another big story that we're following. President Biden tapping advisor Gene Sperling as the administration's point person during the current labor union negotiations for auto workers. The UAW making it clear that whether or not there is a strike, it's up to the automakers, GM, Stellantis, and Ford. Negotiations, well, they kicked off this week. First with Stellantis, now today with Ford. Here to map out the road ahead for the auto industry, we want to bring in Eric Lawrence, Detroit Free Press automotive reporter. Eric, it's good to see you. So before we get into what exactly the union workers are asking for, just give us a sense of how significant this is and what's at stake.
Well, this is a significant round of talks. It comes with the backdrop of the transition to electric vehicles. So it's a key moment for the industry, a lot of changes within the industry. So the union's looking for protections for its workers. Many of them work in powertrain, and a lot of the vehicles obviously tied to internal combustion engine. So a lot of those jobs, there are questions about a lot of those jobs in the long term. Part of what the union has staked out has been the need for job security. They point to plants that have been idle or closed, places like Belvidere, Illinois, where Stellantis had made its Jeep Cherokee. Those are some of the issues. And of course, the union also wants to ensure that the jobs at some of the new battery plants are also have comparable wages to what folks at the other auto facilities have.
Yeah, Eric, you mentioned there the transition to EVs and how union workers are a little bit worried about what that could mean for their jobs going forward. Are they worried that we could see more job cuts as a result? And just break down exactly why that could be the case.
Well, one of the key things is the fact that EVs they have fewer parts. So there will be likely to be fewer people needed to produce these vehicles, and a lot of the jobs that have been in the auto industry in the past, they won't necessarily transition over easily. So they have to, the workers that are there, if they're working in some areas, will need to learn new skills. Battery plant work is going to be different than assembly line work, and you'll see the need for that kind of a transition.
Eric, what are you hearing from automakers? We're going to hear from quarterly results later this month, but in terms of how they are meeting or how they are, I guess, listening to the union workers' demands, how open are they to making some of these changes?
Well, automakers, what they've said is they have a need for flexibility. There's a big focus on China right now. A lot of China recently became the top auto exporter in the world, and they're going to be that's an area where the focus has been on electric vehicles. So these automakers, they're global. They see kind of the global picture, so they're concerned about that. The automakers have been tremendously profitable. That's part of what the UAW has been focused on. They've one of the things they've been referencing is they say $250 billion in profits in the last 10 years. So the industry's been doing quite well. Stellantis, who's the owner of Jeep, Ram, Dodge, Chrysler, that company made $18 billion last year in profit. So while they stress the need to be competitive, they're also talking to the union at a time when they've been very profitable for years. We don't necessarily expect to see a big change in the upcoming quarterly results. We expect they're still doing well, even during the pandemic when there were issues with supply chains, things like that. They were able to maintain pricing pressure. Now, some of that's expected to ease a little bit, but they've basically, even though they maybe not sold as many vehicles as they could have, those vehicles are at really high average transaction prices. So they're doing okay on that front too.
Eric, the timeline of these talks, the fact that it started with Stellantis yesterday, I believe, Ford got underway today, GM next week. Is it normally at the same time, or have the union workers taken a different approach in the past? And why would that be the case?
Well, right now this is starting out pretty similar in terms of timing. You know, they get started in the summer. You know, there are some initial meetings. This is just early days in this process. Just so the specifics with which companies are going first right now, I don't know if that's so significant. You know, normally at some point the union would announce a lead company, and then that would be the company they would do the main kind of negotiations with, and they set a pattern for the other automakers to follow. We're not sure what the union's going to do this time. The union president has said the Detroit 3 is the target. So they've been careful with how they've framed that. So we're not sure. The automakers themselves, you know, they indicate that they're taking it seriously. They think they expect they'll get to some kind of an agreement, but you know, this is a different time. The union is talking in terms that they probably haven't talked in a long time. They've kind of come out swinging. They've kind of put the automakers on notice, and they've told the workers that they expect to fight for a lot this contract. So we'll see. We'll have to see how it turns out. You know, the contracts are in effect until mid-September, and so we won't see a lot of action probably for the next couple of weeks, but it'll start to heat up certainly next month.
Well, Eric, we've heard from a number of analysts. It sounds like largely speaking, they expect a strike. Do you?
Well, that's kind of the expectation. The UAW has not done anything to dissuade us from that. You know, there have been some strikes at some suppliers. There's been a lot of talk about the need to kind of take action and to stand up. I don't think anybody would be surprised to see a strike. Precisely which automaker it might be, you know, we've heard you know, any number of scenarios. I would not be surprised to see a strike. I don't know that a strike is always inevitable. You know, obviously the automakers and a lot of folks connected to the industry are quick to point out the kind of cost of a strike. But I'd say that a lot of the rank and file are pretty motivated this time around. And you know, even 4 years ago, the UAW struck then, and maybe it didn't seem so pressing to folks then. So we'll have to see.
All right. Well, we will follow the negotiations, and like you said, the contract's set to expire in September. Eric Lawrence, great to have you. Thanks so much for joining.
Thank you very much.
Let's do a check of the market, sponsored by Tasty Trade. S&P and Nasdaq ending the day lower. You're looking at the Nasdaq off just about 0.2%. The Dow holding on to gains, up about 0.3%, up 5 days in a row. For the week, the Nasdaq having its best week since the end of March. The Dow having its best week since the end of March as well. The 10-year yield, the biggest weekly drop that we have seen in yields there since March 17th, so just about 4 months. Well, it's closing time here at Yahoo Finance. Here's a look at what to expect next week. Earnings season heats up. Financials are in focus at the start of the week. We will hear from the rest of the big banks, including Morgan Stanley, Goldman Sachs, and Bank of America on Tuesday and Wednesday. Regional bank stocks will also be ones to watch to see how they are recovering from the banking crisis in the spring. We'll also be starting to hear from big tech, some of the key names to watch: Netflix, Tesla, and IBM. Also on track next week, we have the Dow components, Johnson & Johnson and American Express. It's also a busy week on the economic calendar. We will get a read on the consumer on Tuesday with retail sales. Economists expecting sales to jump 0.5%. A string of housing reports are also due across the week, from housing starts to existing home sales and home builder sentiment. And home buyers will be keeping an eye on mortgage rates. Freddie Mac releasing its data on Thursday at noon, and the rate on the 30-year fixed mortgage could get back above 7%. The latest data showing that's just under that level now, hovering at the highest level since November. Well, that'll do it for us today on Yahoo Finance Live. Be sure to come back Monday at 3 p.m. Eastern Time. We've got all your coverage leading up to and after the closing bell. We'll see you then.